Hello and welcome to the EconBuff podcast. I'm your host, Lee Stitzel. With me today is Dr. Luis Fernando Colunga Ramos. Dr. Colunga is an economist at the Bank of Mexico. He received his PhD in economics from the University of Texas at Dallas. He joined the Bank of Mexico in 2021. In his current capacity, his research focuses on regional economics, macroeconomics, and monetary policy. His most recent paper on Divisia monetary aggregates has been accepted for publication at the highly prestigious Journal of Money, Credit, and Banking. He also serves as a professor for UANL in Monterrey, Mexico. Fernando, welcome.
Oh, hey, Hailey, thank you so much for having me here. Thank you so much for the invitation to participate on this podcast. This is my first time being here, being in a podcast like this one. So thank you so much for the invitation to participate on this very friendly conversation. Thank you so much.
Well, thank you for doing the honor of joining us. So our topic today is going to be Divisia monetary aggregates. We're obviously going to kind of have to build up and explain what that is. But first, what I'd like you to do is kind of explain to the audience what the Bank of Mexico is and kind of what it does.
Right, yes. So the Bank of Mexico is the central bank, the Mexico central bank, like the one that you have in the United States, like the Federal Reserve. But here is Banco de Mexico or Bank of Mexico. Some people they confuse the Mexico Central Bank because it has a similar name with a commercial bank, which is Banco Nacional de Mexico. But here in our case for the central bank is Banco de Mexico. So this bank, the central bank, the main objective for the central bank is to provide money for the people, right? In order that we can make transactions. So that is the most important function for the Mexico Central Bank. But at the same time, the central bank has the objective to guarantee, right, the purchasing power of that currency, of bills and coins, right? So in order to do that, the central bank will always want to keep inflation low and stable, right? Difference to the US case in which the Federal Reserve has two objectives, two targets, inflation, but also employment, right? Here in Mexico, we have only one. And that objective, that target is inflation, right? That is basically what we do in the Mexico Central Bank. We care about inflation and we do all the analysis which is required to understand what's going on, right? What can we do to deal with inflation?
Thank you. That's a very useful summary. So the listeners can then think of the Bank of Mexico as analogous to our Federal Reserve in the United States.
Exactly.
Okay. And then, of course, there are nuances and different things there.
Right.
So what I'd like to focus on is what are Divisia monetary aggregates. That's going to be something that actually longtime listeners of the podcast will have heard Dr. Matson talk about a little bit, but obviously we've never sort of delved into that. And that's the goal for the topic today. So can you tell us what Divisia monetary aggregates are and why they might be important?
Okay, yes, Lead. Of course. I'm very happy to talk about Divisia because, as you mentioned, me and my co-author, my advisor in the PhD, we just get accepted one paper regarding to Divisia for Mexico, by the way. But what is Divisia? That is a very good question because not all of us, we know what is Divisia. Even in my case, I didn't know what was Divisia before going to UT Dallas, the University of Texas at Dallas, in which I studied my PhD, right? I had the same question. What is Divisia? Well, Divisia, the literature regarding to Divisia goes to the 70s, 80s, right? With Professor Dr. William Burnett, right? Who proposes, right, that monetary assets in the economy should be aggregated by considering that each monetary asset is different, right? And let me explain why. If you, in a very simple example, right? If you have apples and bananas, you will want to aggregate apples with apples, right? And bananas with bananas. The same analogy applies for the case of monetary assets that they are different. Let me explain with a very simple example with two monetary assets. Let's suppose that you have money in cash and you have money in a saving account. You can use the money that you have in cash to make a transaction right now, immediately, right? You can go to the store, to the grocery, and make a transaction with cash. But you may not use the money that you have in a saving account because there is a term, right? You have to wait to use the money that you have in the saving account. So they are different, right? And they are different in terms of the degree of liquidity. Money in cash is very liquid, but money in a saving account is not as liquid. So since they are different, we cannot just do a simple sum, which is what central banks, they do, just a simple sum. Money in cash plus money in a saving account. What the Divisia index does is to consider that each monetary asset has a different weight, and weights when we aggregate each monetary asset by considering this different degree of liquidity. It's like, for example, if you have a portfolio, right? You want to invest your money. So you're going to assign a different weight for the shares of Pfizer and a different weight for the shares of Walmart. Why? Because they are different. They are different in terms of risk and return, right? So because they are different, you're gonna assign a different weight. If they were equal, the weight would be the same. But in the case of money, like for some other aggregations, if they are different, we have to consider those differences. And that is basically the idea behind Divisia monetary aggregates. For monetary assets, we're gonna aggregate these monetary assets, but we are gonna weight each monetary asset. So that is basically the idea. And as you can see, it makes sense, right? It is very straightforward, the idea. It is very straightforward, the idea. The problem is that for the case of money, it has not been applied like for other assets, financial assets, or for prices of goods and services, production, right? For the case of money. So that is what we want, even for the Mexico's case, right? For the Mexico's case, we didn't have that index, and we are proposing that index for the Mexico's economy. So that is basically the idea. I don't know if I was clear or maybe I got a confusion, right? But hopefully I may have been clear, right?
No, you did great. Let me ask a couple of things just to make sure. So when you're saying monetary assets, the listener should be thinking about this like different money that are in different places. What things would be like included in those different categories, and what things, might they be tempted to think of as money but is not?
Exactly. Okay. So for the use case, for example, there are two aggregations. Two money is classified are two levels of aggregation, and that is pretty much the same for the Mexico's economy. In M1 money one, we're going to have the most liquid assets. For example, cash and money in a checking account. It's money that you can use immediately, right? It's very liquid. We also have another aggregation, like for the use case, M2. And in M2, we're going to have the assets in M1 plus some other assets that they are relatively less liquid. Like, for example, the money that you may have in a saving account, the money that you may have in another instrument or in another monetary assets, like, for example, repos, which are repurchase agreements, or money mutual market funds, right? Shares, right? So in other assets, the same for Mexico. You may also have money, which is less liquid, in public security. So in Mexico, we also consider money, the money that is invested in public security. And in order to do that, we amplify M2 to have M3. So we have M2 plus public securities, and we have M3. More than that, in Mexico, we also consider that some of these assets, right, they may be held by hands of residents, but also by hands of non-residents. Let's say that Lee, he has some pesos. He's a non-resident, right? He's a non-Mexican resident. So we also consider the money that some other people, some other people, not Mexicans, but residents from other countries, they may have, right? They may have. So we have 4 levels of aggregation, M1 and M2, which they are pretty similar to the case of the United States. But we also have M3, in which we include public securities, and we also have M4, in which we also consider that non-residents may have some of these assets, right? So those are basically the assets that we consider. The idea is to consider assets that they are relatively liquid, right? We don't include shares, or we don't include some other assets. We include assets that they are relatively liquid, right?
So what the traditional method is doing is trying to categorize different monetary asset types
Exactly.
by their liquidity.
Exactly.
And what you're saying is, instead of doing that, let's provide a weight. So when you say weight, what does that mean? My intuition as an economist is that you're talking about a price or a cost of some type.
Exactly.
Can you explain that to us?
Exactly. Let's say, for example, that you have 2 assets, right? Money in cash and money in a saving account. Maybe you may have 70% of your money in cash and 30% of your money in a saving account. We only have 2 monetary assets. We want to aggregate the money that you have. But if we do the simple sum, the problem is that we are not considering that this money in 2 different assets, each dollar has to be a different weight because they are not equally liquid. So basically what we do is to weight by constructing an expenditure share. It's just an expenditure share, like the guys that they do their microeconomic, that they take the micro classes, right? They learn that they're gonna divide, right? They're gonna assign their budget, right, according to different goods and services. So basically, here we do the same. We're gonna assign an expenditure share to each monetary asset, and in that expenditure share, we're gonna have how much we're gonna assign, right, of all of our money for each monetary asset times the price, one price, right? Which in Divisia, in the Divisia literature, we call the real user cost, or the opportunity cost, which is just like an spread, right? It's just an spread of interest rates in present volume. That is going to be the price. And if we sum prices and quantities for all these monetary assets, we're going to have the total expenditure. So the share, it is going to be the fraction, right, that we assign or we allocate for each monetary asset with respect to the total expenditure. So that is basically how we're going to weight. So, and you may say, so how are you weighting? How, by constructing these expenditure shares, are you considering the difference of degree of liquidity? Let me tell you how. That is spread, that price for each monetary asset, it is going to be the difference between the interest rates that you may get from holding money in that monetary assets versus the interest rate that you may get from holding the money in another monetary assets. In simpler words, that is going to be your opportunity cost. Let's say, and let's put an example. Let's say that you have money in cash. If you have money in cash, what is the interest rate that you may get from holding cash with you? 0. The nominal interest rate is 0, right? But at the same time, you may have the opportunity to invest your money in a saving account, which is going to give you probably 3%. So the difference between the interest rate that you may get from the saving account and the interest rate from holding cash with you, that difference, which in this case is 3 minus 0, it is going to be 3. That is the price. That is going to be the price for holding cash with you, your opportunity cost. In this case, 3%. So as you can see, the higher the price, the higher the spread, the more liquid the assets. The more liquid the assets. In this case, cash, it is going to be the spread, the higher spreads. So that is going to have, by using the amount of money that you're going to allocate on that monetary asset times the price over the total expenditure, you're going to weight through the price how liquid is one asset and another one. That is pretty much that is pretty much the idea. Okay.
So what I like about this, right, is it's a very powerful application of one of the core intuitions in economics, right?
Exactly.
Which is that we should account for the price signal in this situation.
Exactly.
So let me ask you this, because this is just kind of a question of interest to me,
Yes.
and you would know this, I think, understanding the history here. So we would never just add apples to oranges. We would never just say I have 2 apples, I have 3 oranges, so I have 5.
Exactly.
Everybody sees that's immediately silly, right? So what happened in the history of using M1, M2, M3 aggregates? Were economists just fooled because it seems like everything's in dollars, so we can just add them together, and that was just a thing that we didn't think about, or what happened that made this a contribution that you and your colleagues can make to economics?
Right. Since as an economist, we know that we can do simple sums when we have perfect substitutes, right? So from a theoretical point of view, aggregating stuff that they are not equal, that they are not perfect substitutes, is not realistic. So if we do that, we have an error measurement, right? We have an error when we aggregate. Why? Because theoretically, since a theoretical point of view, we are aggregating something that they are in essence different. So if we consider that these monetary assets, they are different, we believe that we are correcting, we are fixing the problem, and we are proposing a measure for money that is more realistic. Okay, and we may say we're proposing an index that does not suffer from that error measurements. So that is why we believe that we're making a contribution. Again, for prices, it has not the same weight, the price of gas, than the price for shoes. You spend a lot of money in gas, right? So when you aggregate the prices to get the CPI, the Consumer Price Index, you're going to assign a different weight.
Yeah.
Based on what? On how much of your expenditure or your income is spent on that good, right? On gas and shoes, right? On burgers or drinks or whatever. So the same ideas apply for Divisia, but in this case for monetary assets. So we're proposing something, another measure, an alternative that we believe that doesn't suffer from that problem, from that assumption that we have made, which is not realistic. That is pretty much our contribution, right? That is basically the idea.
So I think it's straightforward to see now that you are making a contribution.
Right.
The natural question then is why is that important? Or if I can put that another way, what's wrong with using simple sum in aggregation?
Exactly. That is a very good, that's a very good question. And in order to answer that question, I may focus on the advantages of having a Divisia index. And what are the disadvantages of using the simple sum? Right now, in our paper, what we do is, or in the past, let me tell you a little bit about about what has happened in the past. In the past, some people, they may say, why we don't use money to analyze what happens when the money supply increases or decreases with prices and production. What if we increase the money supply and we want to see what happens with prices? We may know from other countries and for Mexico as well. What happens if we increase the money supply? What happens? We may think, well, now people, they are going to have more money in their pockets. They are going to start to consume more. And as long as we don't produce more, we're going to cause inflation. That is one prediction, right? However, the theory suggests that if you use money as a simple sum, you may not have the correct response on inflation. Why is that? Because you're considering money from a perspective in which there is a problem. There is an error measurement. So in the past, when people, they want to analyze what are the implications of increasing the money supply, they may have found some anomalies, some puzzles. Why is that if we increase the money supply, the inflation rate goes down? It should go up, no? That is an anomaly. That is a puzzle. That is something that we may not expect. So what we argue is, because there is a problem with the measure for the money supply. What if we measure the money supply as we should, but by considering that the different monetary assets that they conform the money supply doesn't suffer, that index, that measure doesn't suffer from that error measurement. And what we find is that if we want to analyze what happens when there is an expansion on the money supply, we don't find those anomalies that you may have if you use the wrong measure, the simple sum. That is one of our contributions. What if we fix the problem on that index, on that measure of the money supply, the simple sum? What if we do that? And what we find is that when we do that, we find more, let's say, the responses of some other variables when you have an expansion or a tightening, a money tightening. The responses on our analysis of inflation and production, they are more consistent with theory, with the textbook predictions, right? So that is one of the things that we may consider as an advantage of using the Divisia index to analyze what happens following an expansion, monetary expansion, on the response of some other variables. That is why we believe that in some way we're contributing to the analysis.
One of the things that economists are very sure about is that inflation is a monetary phenomenon.
Okay.
Yes. Right. And so we all agree on that. If you find an economist that disagrees with that, that's a non-orthodox opinion.
Exactly.
Obviously those have their place in academics, but general consensus is that you're going to have inflation stem from what's going on with money supply. So what you're saying is, if we use simple sums, we have what you call anomalies. So there are problems with the way that we track inflation and money supply against each other. And what you're saying is, when you use a better measure, which we've already established, right? This fits that basic economic intuition of using prices. When you fix that thing that we were very sure about, the relationship between the money supply and inflation, that relationship becomes very clear, and a lot of those anomalies go away.
Exactly. That is exactly the idea.
Very good. So let me ask, when you are looking at the differences between Divisia and simple sum, is it that Divisia, and simple sum, like, they are correlated, right? So if simple sum, if the money supply looks like it's going down, Divisia is also going down, and it's just a matter of like magnitude? Or is it that Divisia and simple sum can diverge quite a lot, such that maybe simple sum says money supply is going up, but Divisia says money supply is going down? Can you give us like a sense of the magnitude
Exactly.
of the problem?
Exactly. Let me, that is a very good question, Lee. I really like that question because it makes sense. It makes sense a lot of question. Let me give you an example. What if you use the simple sum for money for M1, in which you have cash and money in checking accounts? How they are these assets? They are pretty similar. Money in cash and money in a checking account, you're pretty similar. You can use your debit card and you can use cash from your package. So for that case, let's suppose that we produce a Divisia index for these monetary assets. What do we want to find? Pretty much the same because they are the same. They are the same. So if you consider an index for as a simple sum, if you consider the simple sum and you consider the Divisa index for monetary assets that they are the same, you're going to find pretty much the same. So I would say that the correlation for the simple sum and the Divisa index, which considers assets that they are equal, they are pretty similar, they are going to be pretty much the same. They are going to be highly correlated for sure. Why is that? Because they are equal. So in that case, it doesn't make sense our Divisa index. The problem starts when you start to aggregate somewhere assets that they are different. Like for example, money in a saving account. So in that case, we may start and we see that the Divisa index behaves different to the simple sum. And you may say, why? Why you may, I mean, probably most of the time, there is a correlation, positive correlation. But in sometimes you may find that there are differences, there are gaps between one index and another one. So we argue that all of these differences, they are gonna be given or they are gonna be driven by the interest rates, the new information that we are aggregating, which in this case relates to the prices or to the user costs for each monetary asset. I would say, so to sum up, I would say that if for monetary assets that are pretty similar, Divisa and the simple sums, they're going to give you pretty much the same. But as long as we start to aggregate different monetary assets, we may start to see some differences. Those differences, they're going to be driven by the new information that we are adding to the simple sum, which in this case is the information related to the interest rates. So I would say that for the Mexico's case, we have observed that when we observe a monetary expansion by using the simple sum, that expansion was higher when seeing the Divisa index. So the expansion, it can be either higher if you consider one on another one. Usually what we have seen is that it has been higher when we use the Divisa index.
Right.
Exactly.
So now I'm a central bank, and I sort of understand the importance of Divisia. I start to implement that as my preferred measure, if you will. How is that impacting my processes and the way that I conduct monetary policy? So, hopefully listeners are going to understand kind of how we use targets in monetary policy. So go through that. How would we use Divisia versus simple sum versus like targeting an interest rate or something like that?
Right. And right now, many people, they don't think or they don't follow or they don't trust a lot of on the impact of money on the economy. Why? Because they say, well, the central banks, they use the interest rate to achieve their objective. They use the interest rate. So why should we care about money? Why? Why is that? Some of the people that they believe that, or that they have that question, is because in the past they have observed that when they use the money as a simple sum, they find when they are doing their analysis that they find this anomaly. So why should we care about money if we have observed that the responses of the variables that we want to analyze, they are not the ones that we may expect? What they don't know is that we have produced a measure of the money supply that doesn't suffer from that error measurement. And empirically, what we have found is that the responses of some variables like inflation, which is the most important for a central bank, but also production and employment, they make more sense when we use the Divisia index. So what I may say, if in the past some people they stopped believing about the effects of money, and that is because we may argue that was a problem with our measure of the money supply. Now that we are solving that problem, we may continue, right? Or we may start to believe that money can have some effects on the economic variables. It has some advantages. For example, with respect to interest rates, the Divisia index considers not only money balances, but also information about small interest rates. And the interest rates that we use, they are highly related with the interest rate, which is the instrument for the central bank. So we consider our Divisia index like an alternative indicator, just an alternative indicator that it encapsulates. It is like an amalgam that considers more information. That it's a wider or broader index that considers both interest rates but also money balances in the right way. In the right way. So we believe that we are not saying central banks, they should care right now about the Divisia index. We're not saying that. We're saying, well, what if we put on the table another alternative? What if we do that? And what if we do the analysis by considering this index? That is pretty much the idea, and that is why we believe that for a central bank, having the Divisia indices may help to broaden the understanding, to have a better understanding. Mm-hmm. That is pretty much the idea.
So that's a good, I think, foundation for the basics of what Divisia is. As we've talked about here, you've got work that's specific to this. Tell us a little bit about what your work on Divisia aggregates, what it's doing, and why that might be interesting in your position.
Okay. Right now in the Mexico Central Bank, I am working on a regional office in which we do more about regional analysis. We are in the border with the US, where I am in Nuevo León, one of the states in the border with the US, pretty close to Texas, by the way. So most of my analysis, it has to be with regional stuff, regional shocks. But I am still doing my research on Divisia. I am still working on Divisia because we believe that in the future we can do a lot of stuff with this index. For example, in the literature, there are some works that they have been done for some other countries that they suggest that using this index helps to forecast money demands better. So that is one alternative. If the central bank wants to know what is going to be the money demand, that index helps better to forecast the money demand. On the other hand, we may also consider what are the effects of having an expansion on the money supply by considering this index, but take into account that Mexico is a small open economy, and we depend a lot on the US. We depend a lot of the US. 80% of our exports goes to the US, and our exports are 40% of our GDP. So if we use the Divisia index by considering a model in which we assume Mexico's small open economy, we believe that we may amplify the work that we have done in the past, which has been pretty much producing that index for the Mexico's economy. So we believe that we can continue extending. More than that, there are some other works on the Divisia index that they have considered some other monetary assets, like for example, money coming from other sources, like for example, credit cards. So we believe that we can still do a lot of on this. I think that some other Divisia indices that they consider something related with the money used for the for the warming change, some bonds, some bonds, green bonds or something like that. Right. So I think that we can continue doing a lot of stuff on the Divisia indices, and we can produce better and wider Divisia indices for Mexico and for some other countries, by the way.
So let me see if I understand this right, because you've made this allusion a couple times. You're going to have different indices for different countries, right? So you're talking about an index specific to Mexico. Is that because, right, there's a central bank there, and so there's their own money supply, so you need the calculation for that individually? Or are there also different weights because there are different interest rates in those economies?
Okay, so that is a very good question. When we produce the Divisia index, I would say that the most difficult thing, the most challenging part is data. Data regarding to the money balances is very straightforward because we have that data in any central bank has that data, right? So we don't have any problem with that. You can download that data and that's it. The problem with the Divisia indices is to find an interest rate, an implicit interest rate that matches that the match for the interest rate that matches with the monetary assets. For some assets, it's very straightforward. Like for example, for cash, what is the nominal interest rate for cash? 0. Pretty easy. But for some assets, it may be more complicated. So that is the challenging part, to find an interest rate that is, let's say, that it's the appropriate interest rate for each monetary asset. So some people may use. So I think that this should be the interest rate for this monetary asset. Let's say for saving accounts. And some more people, they may say, no, I may believe that we should use this another interest rate because there are many saving accounts in many banks, and so it's very complicated. So at the end, the most challenging part for constructing a Divisia index is to find the interest rates related to each monetary asset that we are going to aggregate. In our case, we believe that after making a very let's say hard work, after having worked very hard investigating, doing the research, we have found the best interest rates. We have the first best for each of our monetary assets. However, we acknowledge for the possibility that some other people, they may argue, well, So maybe for these monetary assets, we should consider another interest rate. So
Yeah.
we acknowledge for that possibility.
So the second thing that you said there is you also want to get more and more categories of monetary assets into the index. Do I have that right?
Yes.
So I think one of the things that can sometimes be confusing to non-economists when we start talking about monetary policy is what is money. And of course, Dr. Matson and Ryan and I are very sort of well aligned on this topic. So when I'm teaching money, I'm teaching that money is a service, and so that comes in a lot of different forms. But I think most people, they hear money, they're thinking of green pieces of paper, and they think cash, and so they're not, like you mentioned, credit cards a minute ago. So what you're saying is you're trying to add more and more categories of things that serve as money within the economy. Is that a good characterization of what it is that you're trying to do with your index?
That is where we would love to do that, to consider more sources for liquidity on the money supply. For example, that money that we may use from a credit card. The problem is, again, data. I don't think that we're going to have the data for constructing a historical index, an index coming from the 2001 or 2002. So we may want to do that. However, we will see if the data constraints they allow us to do that.
Right.
But we have seen that for some other countries, for the US, for example, you have already worked on that. So we may consider that as a possibility for Mexico's economy. But it's just like an idea now.
So then you could make it more accurate, and therefore, sort of go back to that issue we were talking about with anomalies, that we would have an even more accurate measure.
Exactly. That is the idea. Even the idea comes from what you were saying, Lee. Most of the people, we believe that money is just cash. We have that idea. But money is more than cash. It's money in a saving account. It's money in a public security. It's more than that. So if we constrain our analysis to a narrow measure of the money, even when money is more than that, I think that we may omit, or we may have, yes, we are omitting another fraction of the money that is circulating in the economy, and our results, they may be also subject to the fact that we are limited the definition for money. So if money is more than cash, I think that that we may allow for having more an index that consider more assets than only cash. Even some people, I have heard some people that they say, if the problem is that you are aggregating different monetary assets, why you don't use only M1, cash and money checking accounts? In that case, Divisia and the simple sum, they're gonna give you the same. Yes, that is right, but we have to remember that money is more than that. So when we only consider that money is only the money that we have in the pockets or in the wallets, we are not considering that the money that is circulating in the economy, it can be more than that. So the effects of money can be wider. They can go beyond that we may expect if we only consider cash. Exactly. That is pretty much the idea.
What I want to turn to a little bit is you mentioned, right? We talked about there's different indices for different countries, and then you talked about the work of William Barnett and Center for Financial Stability, and they've got these U.S. aggregates, and then now you're working on aggregates for Mexico. Are there differences between those two aggregates, and if so, could you discuss them a little bit?
Okay, so strictly speaking, regarding to the methodology, I think that they shouldn't be differences or big differences because we follow the international standards to produce the Divisia indices. So regarding to the methodology, I don't think that we should have those differences. However, as I mentioned, we may have some differences regarding to the official classification of money. As I mentioned before, in Mexico, we have 4 levels of aggregation for money. And to my understanding, for the US case, they have 2, right? M1 and M2. And there can be some others for the official are M1 and M2. So I may say that if there are some differences, they are related to the aggregation. For M1 and for M2, we shouldn't have differences, but for higher levels of aggregation, we may start to see some differences. Essentially, the idea of Divisia here in the UK and the US, they are the same. I mean, the methodology, we follow the same methodology, so we shouldn't have methodologically speaking or empirically speaking, those differences. Mm-hmm.
So let's talk about the specific to the Mexican economy, as you mentioned a minute ago. Then,
Yes.
so if I use these aggregates, what's the difference in the story that I see being told about like inflation or output? That if I'm using the interest rates or the simple sum, that I don't pick up there. Can you describe that for us?
Yes, for sure. So first of all, when we want to describe or we want to compare the effects of the simple sum and the Divisia index, we may say, well, if we're saying that the simple sum is problematic, we shouldn't compare something that is problematic with something that is not problematic. So we don't like to make that comparison. If something is wrong, why we're going to compare the results or the effects that thing that is wrong with something which is right. We don't like that comparison. But what we like is to make the comparison. What we do really like is to make the comparison between this index, the Divisia index for the money supply, with the usual monetary policy indicator, which is the short-term interest rate. So what we find, or the study behind the effects of this index and the interest rate, tell us that when we use the short-term interest rate, which it can be like an indicator of the monetary policy for any country, very much, we may find some. Let's say that we have an increase on the interest rate. If we have an increase on the interest rate, we may expect that production goes down and inflation goes down as well. That is something that we may expect. Why is that? Because if we increase the interest rates, if we have a monetary tightening, we may reduce our consumption. Right now, it is higher. It is more costly to consume, especially durable goods, like for example a car, or to invest in a new house. That is going to be pretty much more costly. So the idea is that if we increase the interest rates, we reduce consumption, we reduce investment, we reduce aggregate demand, and as a result, we may observe some pressures for inflation to go down. That is what we may expect. That is textbook. However, empirically, we may find that following a monetary tightening, which means an increase on the interest rates, the price level or the inflation rate can go up. Why is that? If we are increasing the interest rate, why the inflation rate it is going to go up? That is a puzzle. We call that the inflation puzzle in macroeconomics. So what we say, well, what if you use an index that it incorporates not only information about money balances, but also about interest rates? And more than that, not only one interest rate, but more interest rates. as a monetary policy indicator. So in this case, following a monetary tightening, we should have a reduction on the money supply. In this case, a reduction on the Divisia index. And what we find is that following a reduction on the money supply, or through this index, what we find is that the inflation rate following a decrease in the money supply is a reduction on the inflation rate and a reduction on the production level. Or in other words, if we have an increase in the money supply, we should have more inflation. That is what we find. So one thing is textbook, but empirically, when we want to analyze what happens following a monetary shock, we find that if we use the usual monetary policy indicator, which in this case it can be the interest rates, that can be a little problematic in some cases. So when we use the Divisia index, their responses following a monetary tightening or a monetary expansion, they are more consistent with textbook, with what the textbook may predict. So that is pretty much the study behind what are the effects of this index, or a monetary expansion measured through this index on output inflation, for example.
So, right, let's say I'm pretty convinced, but
Yes.
let's say all the listeners, they're convinced. They say, okay, throw away simple sum measures. We got this Divisia measure. They still might be confused as to why the story you just told, why does it work that way? If I have a better, more accurate measure of the money supply, right, we're targeting interest rates, right? Why don't those two things then align in the way that you're saying the money supply and inflation eventually align?
Okay, yes. So that is a very good question. And when we analyze the time series for the interest rates and for the Divisia index, we observe a negative relationship, right? When the interest rates go up, the money balances go down. That is so we may expect that if we're having a contraction on the money supply, which it can be through higher interest rates or a decrease in the money balances, we should have the same results. However, empirically, we find that following a restriction or a tightening, monetary tightening, if we use the interest rate or if we use Divisia, the responses are different. So you may ask, why is that? Why, if they are supposed to give you the same results, one is giving you something and another one is giving you something else? Why some responses are consistent with the textbook and why some others they are not? So that is a puzzle. That is still a puzzle for us. But we believe, or we may argue, that since Divisia is a wider indicator, is more than one interest rate. You know what? The central bank has an instrument, which it can be the interest rate. But the central bank and the Federal Reserve, any central bank or any other institution in another world, in another country, in another country, still in another country, they also make open market operations. They sell and buy currency. Okay, so that is another way in which the central banks, they also have an influence on the money supply. They buy bonds, and if they buy bonds, they're gonna give you money in exchange for that bond. They're gonna give you some money. So we believe that by using the Divisia index, we are also incorporating that information. We are incorporating it, and more than that, those operations, they are going to have an influence on interest rates. And we are capturing that information not only of one interest rate, but some interest rates and some money balances in some other monetary assets that one simple interest rate may not have been captured. More than that, for the US case, for example, what happens after the great financial crisis? interest rates, they remain pretty much at the zero level. So does that mean that the central bank, they are not doing something else? They are not trying to influence or to stimulate the economy in another way? The interest rate, they are already zero. So they are not doing anything?
Yeah.
Maybe the answer is yes, they are doing something else. They are trying to stimulate the economy. So how? How is that? Trying to put more money in the economy. How? By buying some assets, some monetary assets that the people we have. In that way, the Divisia index, it is going to capture the money balances, the increase on the money supply, but also the effects that those monetary assets they're going to have on the interest rate. So that is one way in why we consider that the Divisia index is like having the big picture. It's considered more than one interest rate. It is considering more about the operations that the central banks they do or that they have, and the effects that those operations can have not only one interest rate, but in more interest rates. So that is why we believe that the results they may be different, because in some way the Divisia index is considering more information. It's giving us more information about the monetary policy stance of any central bank.
Yeah,
Under
that's a really good answer.
exactly under normal and crisis, normal situations, but also crisis.
So that's a really good answer. But I want to, for clarity here, make sure that that we've got these two things right. So
Yes.
part of what you're saying is a simple sum is not accounting for any interest rates. Using short-term interest rates means we're accounting for a few interest rates. And when we use Divisia, we've got a whole index full of interest rates, so it's much more robust amount of information.
Exactly. That is the idea.
And so then the other thing you said there is and I think this is very illuminates it very well. At the zero lower bound, right, we start to lose information in what's going on with interest rates, and if you only use that as a measure, then you've lost what's actually happening in monetary policy.
Exactly.
So is it the case, right? Because it should be immediately obvious to the listener, right? The interest rate gets down to the zero lower bound, that tool becomes ineffective. I mean, that is one of the central lessons of 2008. And of course, if we'd have been watching, we would have seen that elsewhere in the world, like Japan earlier, but we didn't. We had to learn our lesson firsthand, right? So, but is that particular lesson only? It strikes me that that's not only true in a crisis. That's not only true at zero lower bound. It's just that it's very obvious to see when we get to zero lower bound.
Exactly. Because the central banks they are always operating. Not only during crisis, but during crisis is more evidence that they want to stimulate the economy. Like for example, in the U.S. case, in a more aggressive way. Well, if the interest rate they are already zero, what else we can do? What else can we do? So somewhere alternatives is trying to stimulate the economy, trying to put more money on the economy by doing these open market operations. But during crisis, for sure, it's more evident that happens. Yes. However, that happens all the time. That is the idea.
So we've been going for about an hour now, so I want to kind of bring this in for landing, but I'm going to try to go 2 for 1 here. So I'm going to ask you kind of a 2-part question to let you kind of finish this episode off. So first is what we just said was we look back and we see historically, and then we use better data, and then we better explain the path of inflation in particular, right? But of course, you're talking about all kind of monetary measures. So if we turn that around and then we say, now that we have a better measure for all the reasons that you've discussed, better economic intuition, better fit with models and theory, and better empirical track record, all those things that we would like. How does that then help us when we want to try to hit a policy target and not just explain what has happened? And then the second part of that question would be, what then, as maybe your research or other people that are working on this, what's the direction that research is going to go to sort of help monetary authorities with that policy targeting?
Okay. Okay. So those questions are very hard. Yes. I would say that it's complicated. I mean, what we are doing is trying to, it's hard to convince or to persuade some people that we are in the right way, because some people from some schools, even from some schools, they reject their money has an effect on the economy. They don't believe it, at least for the short run. And we believe that at least for the short run, money can have an impact. So some people, they refuse to talk about money because they say, no, we should concentrate on the interest rates. That is what we use. That is in what we should get. So it's not easy. It's not easy for people that they believe on interest rates, that they only believe on interest rates as an indicator of the monetary policy, to convince them that we can also use, or we can also have an alternative by using these Divisia indexes. So I would say that for the future, as long as we promote or we inform people about all of the advantages of having this index, we may, as long as we try to convince or to persuade people that we are in the right way, we may have more acceptance from all the people, from all the audience, not only from academics, but also from commercial banks, by the way, from central banks. And as long as we, for example, this podcast can help, right, to create more knowledge, to increase knowledge about these topics that for some people they are not familiar. For me, even it was not familiar. But I believe that as long as we have these channels to transmit how important is correcting the measurements that we are, the measures that we have for different variables, as long as we do that, we may try to create more acceptance from all the audience, right? And try to implement this on the analysis. Maybe not on the decisions. Maybe they will not say, okay, let's see what's going on right now with the Divisia index to see if we do something or not. But at least to consider that on the analysis. As I mentioned, it is very important to see what is going to happen if we have a monetary tightening with the variables, with the economic variables like production. We may cause a recession. We don't know. We don't know what is going to happen. So if decisions, they're going to be made based on information, based on data, we believe, or we argue that the data or the analysis has to be made based on the right measurements for all the variables. So that is that is in one way in which we believe we can contribute. And for example, through the publication of this paper in the JMCB, we believe that more people, they may start to ask themselves, so what is that? What is that? Right. So like, for example, for the Mexico's economy or for some other economies. So what is Divisia? And why should we care about Divisia? Why is that? So even when the story about Divisia for monetary assets comes from the 70s, 80s, almost more than 40 years, I think that we can still do much more to continue trying to put this discussion on all the audience, students, academics, central banks, commercial banks, on all of the people that we care about what is gonna happen with the economy.
My guest today has been Dr. Fernando Colunga. Fernando, thanks for joining us on the EconBuff.
Thank you so much, and thank you so much, Lee. Thank you so much for having me here on this podcast. I really appreciate this invitation.
Thank you for listening to this episode of the EconBuff. You can find all previous episodes on YouTube at EconBuff Podcast. You can check out our website at econbuffpodcast.wixsite.com. That's WIXSIT.com. You can contact us at econbuffpodcast@yahoo.com.